I will delete this file in 20 minutes. Not because I'm afraid, because this is how the system works. If you understand too early, you are supposed to disappear. At 6:12 a.m., the terminal on my desk didn't flash red. It didn't scream. It simply stopped updating. Quietly, like someone pulled the heartbeat out of the screen. And in that moment, I understood something most people never will. The margin call had already happened. They just hadn't told you yet. $94. That number is not from the news. You won't find it in headlines. It isn't meant for you. It's an internal threshold, a line buried in a stress report that never gets printed. The level at which paper silver stops being an asset and starts becoming a balance sheet problem. And that is exactly where Bank of America began dumping paper silver. Not hedging, not rebalancing, dumping, right now. I was in the room where the decision was made, not officially, of course. It was labeled an operational liquidity review. 42nd floor, no windows, cold air, stale coffee. A 6:15 a.m. meeting because fewer people are watching at that hour. On the table was a report with no logo, no letterhead, just a code on the corner. 404B SLV. At the bottom, in smaller text, a stress scenario at $94 per ounce. Not market price. Settlement price. Physical execution price under simultaneous delivery demand. People's fingers were damp, not from fear, from concentration. When someone realizes the math is against them, they stop sweating emotionally and start sweating from effort. The effort of holding control. One of the risk officers wouldn't look up. He kept his eyes on the table, because he knew that if anyone asked out loud why now, he would have to answer honestly. And the honest answer is this: the margin call already triggered inside the system. Here's the anatomy. Paper silver is not metal, it's a promise. A promise that only exists as long as nobody asks for delivery. Bank of America is one of the largest holders of short exposure in silver through derivatives. That isn't controversial. The uncomfortable part is why that position only worked in a world where price was controlled by paper liquidity. When physical reality starts dictating terms, paper becomes a noose. Late Sunday night, one of the clearing algorithms threw an internal warning. Not a fatal error. A yellow flag. I saw the log. RRM94LQ. That code means that at $94 and above, the margin coverage ratio collapses under a standard liquidity drain scenario. In plain language, if silver goes there and contract holders start asking for metal at the same time, the bank must either post additional collateral immediately or close the position at any price. Immediately, not next quarter, not after earnings, immediately. But there is nothing left to post. Collateral is either cash or physical metal. Cash is already stretched. The metal doesn't exist on the balance sheet in deliverable form. Not because silver doesn't exist in the world, but because the same ounces are already promised 10 times over to 10 different claims. This is the moment trading floors go silent. Not shouting, not chaos. Silence. The moment everyone understands that the exit is mathematical, not emotional. So the logic of the beast takes over. Banks don't think in morality. They think in ratios. If maintaining a position triggers an $11 billion margin requirement, and closing that position produces a smaller realized loss, they choose the smaller wound. Even if it poisons the market, even if it detonates a chain reaction. Survival of the balance sheet comes first. I saw the numbers. At $94, the projected margin deficit across linked silver derivatives exceeded $11.3 billion. That's not a loss. That's a demand. Cash that must appear instantly. And if it doesn't, clearing forces liquidation. That's the system people call stable. So Bank of America starts unloading paper silver. Volume rises. Paper price softens temporarily. Headlines calm everyone down. Silver under pressure. The crowd relaxes, but the physical market doesn't move. Deliveries don't accelerate. Inventories don't refill. The opposite happens. The people who understand what's going on move faster. Physical buying intensifies. Premiums rise. The spread between paper and physical widens. And that widens the stress test. Because clearing doesn't only look at futures prices. It looks at delivery risk. The larger the gap between paper price and physical availability, the higher the risk coefficient. The higher the coefficient, the larger the margin requirement, which forces more paper selling, which widens the gap even further. This is the feedback loop, a closed circuit, a system eating itself. I watched it on the terminal, updates every 500 milliseconds. Then the cursor froze, then a jump, then empty space in the order book. This isn't volatility. This is the absence of counterparties. Algorithms keep firing, but there is nobody left on the other side. And when that happens, the system does what it always does. It sacrifices those who believe in the price to protect those who control access. Why doesn't the crowd see this? Because they are shown averages, not mechanics. They are fed inflation prints, rate commentary, macro noise. They are not shown Report 404B. They are never told that margin calls can happen before price moves, not after. They are not told that a bank can begin dumping exposure today to avoid dying tomorrow. Paper markets exist for one reason: to hide scarcity. When demand exceeds supply, price should explode. Paper prevents that by creating the illusion of infinite availability. But illusions only work until someone asks for the real thing. That moment has arrived. At that meeting, when someone finally said, "We need to reduce exposure immediately," nobody asked why. They didn't need to. Silver had stopped obeying the model, and when an asset exits the model, banks stop caring about the future of the market and focus on the survival of the ledger. I left the building at 7:03 a.m. The sun was coming up. People were heading to work, unaware that a decision had already been made that would redefine their idea of a stable market. They will read about it later. They will be confused. They will look for villains. But there are no villains here. There is math, and there is physics. $94 is not a target. It is a trigger. And if you think this is only about silver, you haven't understood anything. Silver is the test case, the most uncomfortable metal. Too small a market, too critical for industry, too easy to turn from paper into a balance sheet emergency. Bank of America is not panicking. Panic is for people who don't understand the system. They are acting coldly, precisely. And that is what should terrify you. Because cold decisions produce the hottest chain reactions. When the next bank realizes paper no longer protects them, they will do the same thing. Not because they want to, because they have to. And then you will hear new phrases, not on television, in fine print. Temporary measures, liquidity management, market integrity. What it really means is closed doors and rising premiums on what was called liquid yesterday. This is not the end. This is the beginning of a phase where margin calls happen before price discovery. Where markets break internally first, and only later do they show you a chart. Where $94 is not a ceiling, but the line beyond which paper stops making sense. I've said enough for now, and here the road splits into 3 paths, and every one of them leads toward the same cliff, just at different speeds. The system will tell you these are choices. They are not. They are delays. What matters is not which path is taken, but how much time is bought before physics collects its debt. The first path is the one they will sell you as stability. The calm version. Silver drifts higher in controlled increments. Volatility is suppressed. Paper markets remain open and liquid enough to maintain the illusion of order. Banks quietly reduce exposure over weeks instead of days. The word normalization is used again. Commentators talk about a healthy consolidation. This is the optimistic story, and it works only if physical demand can be stalled without triggering visible shortages. But even in this version, nothing is fixed. It is only stretched. Because every ounce that fails to appear when requested tightens the coil. Premiums remain elevated. Delivery times stay long. Industrial buyers begin to hedge availability instead of price. The market looks functional, but it behaves defensively. This is the version where people say afterward, "We had time," without realizing that time was being consumed, not stored. Then the road bends, almost imperceptibly, into the version that feels more honest. The realistic one. Paper prices become unstable. Rallies are sharp and violent, followed by sudden air pockets where liquidity vanishes. Clearing requirements change quietly. Margin terms are adjusted without announcement. Smaller players are forced out, not by losses, but by paperwork. The market narrows, fewer participants, larger trades, less tolerance for error. In this version, you start seeing the behavior that matters, not price, but preference. Large institutions stop leasing metal, vault transfers slow. Inventory reports become less frequent and less detailed. Executives don't talk about silver anymore. They don't need to. Silence is a position, and while paper trades back and forth, the physical market becomes a negotiation instead of a transaction. This is where people begin to feel something is wrong without being able to articulate it. They notice that buy no longer means the same thing. That availability depends on relationships. That price quotes come with a pause before confirmation. The system still works, but only for those it chooses to work for. And then there is the third path, the one no one models publicly because it breaks too many assumptions at once. This is where the feedback loop snaps, where a sharp move forces simultaneous margin calls across multiple desks, where one large player failing to meet requirements causes clearing to tighten across the board, where paper selling accelerates not to manage risk, but to survive the day. In this version, the paper price collapses briefly under forced liquidation, even as physical premiums explode. The divergence becomes undeniable. Headlines lag. People argue about manipulation while dealers stop quoting altogether. This is not a crash in the way people imagine. It is worse. It is disorderly continuity. Markets open, trades print, but access disappears. And that is when panic finally arrives, not as noise, but as motion. Requests, transfers, redemptions. Everyone discovering at once that liquidity is conditional, that what they owned was an agreement, not an object. That settlement can be redefined when the alternative is failure. Do not look for this in the news. News will always be late. Do not watch the silver price on your phone. That number will lie to you the longest. If you want to understand which road you are on, watch the things no one promotes. Watch bond yields, not because they predict silver, but because they reveal stress. When long-term yields refuse to fall during equity rallies, it means capital is not seeking safety. It is trapped. Watch short-term funding rates, especially overnight facilities. When banks prefer central windows to private markets, it tells you trust is gone. Watch inventory behavior, not reported totals. Watch how often updates are delayed. Watch how categories are merged or renamed. Eligible becomes registered. Then, registered becomes available subject to conditions. Language always changes before rules do. Watch elite behavior. Not what they say, but what they stop doing. When executives quietly reduce public exposure. When boards authorize asset transfers that make no sense under normal conditions. When insiders stop selling products they once pushed aggressively. These are not coincidences. These are exits. And most of all, watch delivery. Always delivery. When a system built on promises begins to discourage fulfillment, you are no longer in a market. You are in rationing. So what do you do in a world like this? Not loudly, not emotionally. You do the opposite of what the system rewards during good times. You reduce complexity. You shorten chains. You convert claims into things that do not require permission. Physical metal is not about upside. It never was. It is about refusal. The refusal to be settled in something else. The refusal to accept a substitute when the contract was clear. Physical gold and silver are not investments in this phase. They are exits from a game whose rules are changing mid-play. Cash matters too, but not in the way people think. Cash is not safety. Cash is time. Time to wait. Time to choose. Time to say no. But only if it is accessible. Only if it is not trapped behind institutions that can redefine access overnight. Cash that cannot move is not cash. It is another promise. This is not about going all in on anything. Extremes get punished. This is about balance in the original sense of the word. Balance as in the ability to stand without leaning on a single structure. And above all, it is about resisting urgency. The system will try to rush you. It will use volatility to force decisions. It will use narratives to herd behavior. Urgency is its most effective weapon because urgency removes consent. You do not need to predict the exact outcome to survive this phase. You need to recognize when the system is trying to take away your right to choose timing. That right is more valuable than any price target. This is the part no one likes to hear. There is no safe crowd here. There is no index that saves you. There is no authority that guarantees fairness when scarcity appears. Systems protect themselves first. Always. That is not corruption. That is design. And this is where the philosophy matters. The right to say no is the only real hedge left. No to forced settlement. No to substitute assets. No to explanations that arrive after the decision. No to urgency disguised as opportunity. Saying no does not mean opting out of the world. It means refusing to participate in a lie once you see it. Responsibility is heavy because it removes excuses. Once you understand that the rules can change without your consent, you lose the comfort of pretending you didn't know. That weight does not go away. It stays with you. It should. The people who come out of this intact will not be the loudest or the smartest or the most confident. They will be the ones who kept their autonomy when others traded it for convenience. They will be the ones who understood that in a leveraged system, survival is not about being right. It is about not being forced. Margin calls at $94 are not about silver. They are about the boundary where promises fail. Once you see that boundary, you start noticing it everywhere. Different assets, same mechanics, same silence before the move. This horizon does not announce itself with fireworks. It arrives quietly with changed terms and missing options. And by the time the crowd understands what happened, the most important decisions will already be behind them. You are still early enough to choose how you stand, not what you buy, how you stand. Because when the system finally asks for compliance instead of confidence, the only people who keep their freedom are the ones who practice saying no long before they were forced to.